What if there were a way to short a stock, with no borrow fee, no margin call, and nothing a regulator could ban? In 2008, when the US banned short selling in hundreds of financial stocks, this still worked. How? Because you never borrow anything, you already own it, but how is that even possible? Over the last 6 parts, we built the whole machine and the map. We learned to put two prices on the same scale with normalization, to turn that pair into a single line, the spread, to decide how many shares of each to trade, co-integration. We covered risk and the process a pro runs before a trade, and last time what to actually pair, the universe of pairs. So the theory is done, which leaves today's question: how do you actually trade this? That's the thing beginners search for once the theory clicks. Today, 3 moves the pros make and beginners skip: knowing where you stand, getting in without guessing, and the one I promised in the cold open, shorting without borrowing. And one idea runs through all 3. Edge comes from structure, not prediction. By the end, you'll know exactly what that means. Because to reach that borrow-free short, we have to start with the 2 moves that come first. First move. Before you trade, you need to know what kind of arbitrage you're even doing. Arbitrage splits into 3 tiers. At the top is risk-free arbitrage, where the risk is close to 0. The classic example is the gap between an index future and a basket of stocks that copies that index. If the future is too expensive, you sell the future, buy the basket, and pocket the difference when they line up at expiry. You can even build a fake future out of options and trade it against the real one. The catch is, these near-free opportunities get eaten by algorithms in milliseconds. They're gone before you even see them. And that process is exactly what keeps markets efficient. It forces the same thing to carry the same price. Honestly, this top tier is not where an individual trader lives. The bottom tier, where we stand, is statistical arbitrage. You're using the fact that the spread between 2 assets pulls back toward its balance point, but only in a probabilistic way. Pairs trading lives right here, and there's one thing you must remember. Statistical means not certain. This is not a free lunch. We get paid for carrying statistical risk, so don't bet like it's risk-free money. That's the whole first move, pricing the risk you're actually taking, honestly. Second move. The spread is stretched wide, time to get in. But where exactly? At the very bottom? Let's be honest here. Nobody catches the exact bottom. Whether the spread widens further or whether this is the low is really a matter of prediction, and the prediction game usually loses. Think about a directional bet. Say you pick the right stock 8 times out of 10, and you time it right 8 times out of 10. You need both to work, so your combined odds drop to about 6 in 10. And every time you're wrong and cut the position, that frequent stop loss quietly eats your returns. So the pros give up on prediction. Instead, they scale in. Not all at once, a little at a time, over several entries. Then your entry price becomes the average of that stretch. You don't have to nail the low, you get in around the average low. You've swapped a prediction problem, timing, for a structure, the average. But there's a much prettier piece of math hiding inside scaling in. This is the heart of the episode. Say you buy each of the pair's 2 stocks in pieces over several days. Then your average cost in each stock becomes that stock's moving average. And since both legs went in on their moving averages, the spread you actually hold becomes the moving average of the original spread. That jagged spread turns into a smoothed version of itself. And 2 things here are beautiful. First, this result is independent of the hedge ratio. Whatever co-integration coefficient you chose, scaling in automatically puts you into the moving average of the spread. Second, the spread's core property, that pull back toward the mean, stays exactly the same, but the swings get smaller. You get the same edge with less bounce. Not because you predicted better, but because you structured the entry. There's a bonus too. Over time, as prices move, the hedge ratio you set at the start drifts out of line. That problem we flagged in parts 4 and 5. But every time you scale in with another piece, you get a chance to rebalance the whole hedge ratio. One move, scaling in, cuts your timing risk and quietly repairs the drifting hedge at the same time. Of course, scaling in doesn't make risk disappear. If the spread never comes back, you still lose. Scaling is a tool that smooths risk, not one that erases it. Now back to the cold open. Third move. Pairs trading buys one side and shorts the other, but shorting comes with quiet costs. First, you pay a borrow fee every year to rent the stock. Second, if the lender suddenly wants the stock back, you can be forced to close at the worst possible moment. That's recall risk. And third, in the extreme, a regulator can simply ban shorting altogether. That really happened. In the 2008 financial crisis, the U.S. Securities and Exchange Commission banned short selling in hundreds of financial stocks for a stretch. Back in Part 6, we saw one way around this, buying an inverse ETF instead of shorting the index directly. That's a good fix, but today we go deeper. Notice what the borrow fee, the recall, and the ban all have in common. They exist because you borrowed. So the question is simple. What if you never borrow at all? Here's the answer. It's a method called holding pairs trading. The core idea is this. When the whole market has fallen hard and stocks are cheap, you buy the names you'll pairs trade and simply hold them. Say two big banks. Let's call them JP Morgan and Bank of America. This is an illustrative example, not a recommendation. You own both upfront in your portfolio. Now a moment comes when JP Morgan looks rich and Bank of America looks cheap. Normally, you'd short JP Morgan, but you already own it. So instead of borrowing, you just sell the JP Morgan you're holding. That has the exact same effect as a short, and with that cash, you buy more of the cheap one, Bank of America. Later, when the two converge back to balance, you sell the extra Bank of America and buy back the JP Morgan to refill your holding. Your portfolio ends up exactly as it started, but the profit from buying low and selling high stays with you. So, no new money went in, the portfolio is the same size, and yet profit keeps stacking up. On top of that, if the whole market rises, you keep that gain too, the index beta. And above all, since you never borrowed anything, your borrow fee is zero, there's no recall, and even if shorting gets banned like it did in 2008, it makes no difference to you. You're selling what you already own. It's about as close to a complete arbitrage as it gets, and it's a lot calmer to hold. So, buy when the market is cheap. When is that exactly? Here the pros look at the index's very long-run trend line, the average upward path of the index over decades. Take a broad index like the S&P 500 over the long haul, and you'll see it swing above and below that trend line. The whole market mean reverts in a sense too. The rule is simple. When the index sits above the trend line, as it does now, you run ordinary long-short pairs trades. It's not the season to load up. But when the index falls well below the trend, that's when it can make sense to switch to holding pairs trading. Buy cheap, hold, and run that borrow-free short we just saw. One honest note. This trend line is not a crystal ball. As the index moves, the trend line itself shifts a little. The same mean drift problem we covered in Part 5. So it doesn't tell you this is the exact bottom. It gives you a sense of position. Is this a season to pre-buy or not? Position, not prediction. We saw 3 moves today, and they're really one idea. In the first move, we admitted where we stand. Statistical arbitrage. Not free money, but a place where you're paid for carrying statistical risk. In the second move, we removed timing risk by scaling in, swapping the hunt for the bottom for an average. And in the third, we removed borrow risk entirely by selling what we already own. See the pattern? What we did was not predict the market better. We took the risks we could remove, timing, borrowing, and we structured them away, one by one, and we kept only the risk we can't remove, whether the spread comes back, the statistical risk. So that's the only place we take our reward. That's the takeaway. Don't try to predict better. Design better. Remove the risks you can with structure and get paid only for the risk you can't. And this isn't just a pairs trading idea. Buying in regular installments, a market maker supplying liquidity from inventory, a business that locks down fixed costs with contracts and earns its margin only on demand. Same grammar, all of it. Edge comes from structure, not prediction. That wraps up the basics. We built the machine that trades a pair, we mapped what to pair, and today we picked up the 3 pro moves for actually running it. From the next part on, we move into reading and watching the spread, the technical signals that tell you when to get in and out, ratio spreads and VWAP spreads, and the monitoring you run to watch a position in real time. It's about actually operating on the screen everything we've built so far. And finally, every name in this video is an example to explain an idea, not a recommendation, and this is not financial advice. Do your own research and only take risk you can afford. See you in the next one.